While amateurs finish their Sunday dinners, professionals are watching the clock. They are waiting for 5 p.m. Eastern with absolute focus. Retail trading platforms may go dark on Friday evening, but the global economy never stops moving. Over the next 48 hours, geopolitical shifts, central bank comments, and economic data continue to hit the wires. This creates a massive, unpriced backlog of information. Pressure builds within this liquidity vacuum, ensuring a violent and immediate price adjustment the exact second the market officially reopens. At 5 p.m. on Sunday, the price reopens with a massive leap, leaving a physical hole in the price history rather than resuming at the previous level. This skipped space is a liquidity void, a zone where no trading occurred and no resting orders exist. Amateurs often gamble on the myth that all gaps must fill, instinctively executing trades at the very first Sunday tick. This impatience leads directly into the spread trap. In these initial chaotic minutes, brokers widen transaction spreads by 5 to 10 times their normal size. Entering immediately guarantees an instant heavy loss before the market establishes a directional bias. The Sunday gap represents a high-speed search. The market algorithm is hunting for the first available pool of deep-pocketed buyers or sellers to match a weekend's worth of orders. The Friday closing price acts as a technical magnet. Institutions use these levels to rebalance their books, pulling the price back toward the pre-weekend fair value. We filter these opportunities with the 3x SPED rule. If a gap is too small, your entire profit potential is consumed by transaction costs. A trade only becomes viable when the physical distance of the gap exceeds 3 times the current wide-end spread. We then apply the average true range, or ATR, ceiling, to measure the gap against the pair's standard daily volatility. A gap that blasts through this ATR limit represents a fundamental breakaway trend. News of this magnitude overrides the technical pull of the Friday close, signaling a new direction rather than a return to the void. Professionals use this mathematical funnel to isolate anomalies where the institutional flow is clear and the cost-to-profit ratio is in their favor. For the first 14 minutes of the Sunday open, you must remain completely inactive. Wait for the first 15-minute candle to absorb the initial volatility. You need the price to stabilize before you can identify a bias. Look for an M15 reversal pattern, like a pin bar or engulfing candle, pointing back toward the Friday close. Your entry is the break of that candle's high or low. This confirmation proves that order matching has stabilized and the journey back toward the Friday magnet has officially begun. Set your take-profit target exactly at the Friday closing price. Place your stop-loss just beyond the extreme high or low of the Sunday opening swing to secure a mathematical risk-reward ratio of at least 1 to 1.5. You are trading on a deadline that expires at 3 a.m. Eastern, the London Open. If the gap hasn't filled by 3 a.m., execute a manual time stop. Close the trade regardless of its current profit or loss. The London Open brings a massive influx of volume and fresh directional trends. This new liquidity permanently overrides the weekend's fading void. Weekend gap trading is a surgical extraction of institutional liquidity that ends the moment the broader market wakes up. To trade these voids with 0 pip spreads,